A Merger and Acquisition Guide. Chapter 1. Mergers and Acquisitions 1. Before you expand. Before you decide to buy another company, merge with one or acquire one, you must do as Socrates, the Greek philosopher, said, know thyself. Many business owners are always one step ahead of themselves. I think this is due to the capitalist paradigm of success. Always have more on your plate than you can realistically handle, but the work usually gets done and you end up smelling like a rose, at least to yourself, in your own mind. I've known a number of people like this. They're hooked on being busy. As long as they have work business to take care of, they think that it will lead to success and more money in the long run, but I must caution you very heavily. It's okay to run around and work your ass off in running your company. In most cases, you're just letting off steam. You're not risking the company, but by buying a new company, merging with one or acquiring one, chances are you're putting your main company at risk. Many people have lost it all by trying to expand when they weren't ready financially and otherwise. Do a deep analysis of your company's financial standing and do an analysis of your soul to determine if this is right for you at this point in time. Get an outside audit done by an independent accountant, auditor, or consultant if you want, but there is nothing as good as looking your own company over yourself to get a true, intuitive feel of whether you can handle a significant expansion or not. Do an analysis of your own company first, as in-depth as the investigation you would do on the company you want to buy, merge with or acquire. Do a company or corporate profile on yourself to see exactly where you stand. Corporate profile/investigative checklist. A corporate profile is a report on your company that you prepare for a number of reasons, like to present to potential investors when looking for funding or potential companies you might want to merge with or acquire. A corporate/company profile could be as in-depth as a business plan. To get an idea of what a corporate profile should look like, go to any company's annual report at sec.gov or go to a business plan website and use that as a guide to write out your own company profile. Start out with a verbal description of the company in your own words. Write an article about your business, where you've been, where you are now, and where you want to go. Follow this up with financial statements that describe the company's business, markets, and operations. In addition to doing a paper corporate profile, you can also include a video or DVD of the company with it and even set up a website with your corporate profile on it. After all, you're transparent. You've got nothing to hide from anyone, not even from yourself. You want to see exactly where you stand. A corporate profile can and should also be used as a rough guideline when investigating a company you plan to buy, merge with or acquire. A corporate profile should include the following elements: company history, corporate structure, list of owners, managerial/organizational flowchart, company's business, products and/or services it offers in the marketplace, buildings, facilities, and equipment, sales and marketing division, customer base, who are your customers demographic-wise, competition, financial statements for past several years along with written commentary, any company product or promotional literature including brochures and catalogs, SEC quarterly and annual filing reports, forecast for the future, your vision for growth, written explanation for anything not covered or anything that may need an explanation. Some other possible topics are: description of the top people or person, financial statements like an income statement and a balance sheet, accounting and finance, administration and executive, ancillary business away from your main business, assets, possessions, classes of stock, options, and other securities, if applicable, company structure, competition, customer profile, expansion ideas, foreign sales, ideas for the future. Include your website name, catalog, sales brochure, and other literature the company puts out. Independent contractors, intellectual property the company owns, patents, copyrights, trademarks, inventory control, inventory on hand, lawsuits, litigation in process, past litigation, loans, money owed, major customers, marketing, advertising, and sales, new products or services, number of employees, owners of the company, percentage ownership, production, products and services you sell, profile of people who manufacture your products by contract, required licenses and permits, research and development, sales methods, seasonality of the business, strengths, subsidiaries or other companies you own, suppliers, taxes, do you owe back taxes, type of computer software you use, weaknesses, your competitive advantage, investigation beyond a corporate profile. Just watch CNBC's American Greed. Fast Eddie in New York got a bunch of empty boxes and stacked them up, then moved them to about 3 different warehouses to show prospective investors that he had inventory. The fraud goes on and on. People look for big fish to invest in their fraudulent schemes. Before you buy a company, sit outside of it for a few days undercover to watch what's going on. Beyond a corporate profile, the way to find out more information about any company including your own is to do the following steps. Do basic research on the company through its SEC filings, database brokers, company websites, corporate websites, newspaper articles, its promotional literature, etc. Do a search engine search. Interview or talk to employees, customers, and competitors informally about the company. Watch the way the company operates. Try to get an insider on your payroll or get someone to work there undercover, then report back to you what's really going in. You're just like a reporter looking for the real story. Talk to the company suppliers. Ask how prompt they are in paying their bills. Look at the company's books to see how its accounting is done and whether they have a positive cash flow. Determine the company's geographical and demographic market area and decide if you can improve on that. Evaluate the company's sales strategy and determine if you can better it. Learn what you can to get an intuitive feel for the company. Pay either an accountant, auditor, or consultant to do an independent audit of the company. Talk to the owners and managers. Try to do this separately, one by one, to see if their stories match or if they tell you conflicting things. Chapter 2. Mergers and Acquisitions 2. Mergers and Acquisitions. A merger is a marriage. An acquisition is a takeover. Companies try to acquire other companies all the time, mainly for growth and some to trash them in the corporate raider sense to make quick money. Mergers are a partnership. 2 companies unite to become one, often keeping top management from both of them. Hostile takeovers are a situation where a company tries to acquire shares of another company to get a majority ownership, 51%, to have the power to make all the decisions. Your company may merge with another, acquire another company, or be acquired, in which case there are professional consultants, attorneys, and accountants around who deal with that situation. You have to do research on the company that you want to acquire, merge with, or be acquired by, which should be easily available through the many directories at the library like the Thomas Register, Standard & Poor's, Moody's, Dun & Bradstreet, as well as many websites like sec.gov for publicly traded companies. In general, M&As are complicated legal and business affairs. The basic steps of the operation are: do some research to determine if the 2 firms will fit well together. Do some research to determine the true value of the firm and what it's worth to you. Negotiate to come to a fair price and fair terms. Once 2 companies reach an initial preliminary agreement, the process moves into the legal and business due diligence phase, where both companies examine the other's documents, production, etc. in order to determine whether everything is solid enough to justify closing the transaction. It's like a court case where both sides open their files to each other so they can examine them. In a merger, both companies examine one another. In an acquisition, the acquirer examines the target company under a microscope. It's quite tedious. Your lawyer, consultant, and accountant, will handle most of it. After the due diligence process, an offer is made, they haggle with each other and either reach what is generally a complex agreement or the deal is off. Each partner brings two kinds of items to a merger. Financial statement. Non-financial statement items. Each side must prepare these two statements and present them to the other side for scrutiny. The general items on the financial statement are: cash on hand, liquid money; accounts receivable, what is owed to the company; inventory, what products do you have; how good of a record keeper are you; real estate, land, buildings; capital, equipment, machines; accounts payable, both short and long term. Beyond a financial statement, you should put together a written statement describing the business in your own words. This is not as rigid as a business plan but a report detailing the strengths and weaknesses that are unique to you and your business. This is called a non-financial statement and includes the following factors. Describe the strengths, vision, and weaknesses of the business. List all business associates like your lawyer, accountant, suppliers, major customers, employees, etc. Talk about what you could do to improve the business. Merger guide. To merge is to combine or unite with another company, which is what happens when the stocks/shares of two companies are merged. One of the companies disappears and is absorbed into the value of the stock of the other company. In a merger transaction, one company absorbs another. Since mergers are big deals, they often only occur with large, publicly traded companies such that the procedure involves an exchange of the common stock. A big advantage of a merger versus an acquisition for the seller is that merger transactions are generally exempt from capital gains taxes and other taxes. For the buyer, a merger is basically a stock purchase and treated as such for tax purposes. The buyer buys enough stock to take control of the company. By the rules of the seconds, publicly traded companies are required to keep strict records for public inspection, so if the company is being honest, its records are all there in its corporate filings for the buyer to inspect them. In a regular merger, two companies unite and exchange stock or some other form of equity interest without money in order to avoid capital gains taxes. It's a meeting of the minds, a partnership, a marriage, call it what you will, but the most important thing is the stockholders' agreement, often called the prenuptial agreement in the biz. Before the merger, a meticulous contract has to be drawn up that covers every situation and contingency imaginable that both sides are satisfied with. A merger is different from an acquisition in the sense that with acquisition, one company is the big cheese and the other one is either gone or out, but with a merger the major players from both companies are still part of the game, so they have to deal with it and make up a contract to relegate the decision-making power. The contract must be crystal clear in advance in order to avoid possible hassles down the line. The following points should be addressed. 1. What does each side hope to get out of the deal? What is your long-term objective? Where does the other company fit into your plans? What is the exact situation and motivation going on here? 2. Why merge? What's in it for both sides? Will there be overall lower costs because you will not be duplicating administrative departments, etc.? Will there be other economic advantages and savings by merging? 3. Who is going to be the big cheese of the whole show? How will the power be distributed? These things must be very clearly defined. Make up a stockholders' agreement in advance so the stockholders of the target company know what they're in for. Corporate governance is the process of managing a company, picking who will serve on its board of directors. 4. Who gets what in terms of physical equipment, money, shares, etc. 5. What about an out clause, an exit strategy so to speak? You have to write up a set of conditions which, if violated, renders the deal off. What about contingency plans such as if someone dies or someone screws up? 6. When can the new shareholders turn their interest into cash? A hostile takeover is a situation where one company wants to take control of another company by buying up its shares on the open market even though the managers of that company are against it. A friendly takeover is where the managers meet, talk, set terms, do inspections, etc. The best merger is one where both the buyer and the seller want basically the same thing, or the merged company stands to make a lot of money by the merger. Often in business there's no perfect fit, so there is usually some kind of haggling and negotiation going on. For tax purposes, most mergers are governed by Internal Revenue Code sections 351 through 368, which are geared for forms of corporate reorganizations labeled in categories A to G. These mergers are tax-exempt transactions for both sides. The buyer and the seller. Merger transactions are covered mainly in the A, B, and C categories. There are three major requirements for making a merger transaction exempt from taxes. 1. The transaction has to have a definite business purpose. It can't be just structured to avoid taxes. 2. There must be a continuity of business, which means that the acquiring corporation must either continue the business of the other company or at least do business in a similar vein. 3. There must be a continuity of interest, which means that the shareholders from the target must maintain a fair share of stock and voting rights. There are various types of mergers, but the most common are the forward and reverse merger. A forward merger merges stock from one company into another master company, with only the stock from the master company remaining after the merger. The acquired company disappears as a legal entity. A reverse merger is the opposite of a forward merger. The buying company merges with the company it bought such that it, the buying company, disappears as a legal entity, and the bought company keeps its name and takes on the value of both companies. There could be a number of reasons for a reverse merger, the most common being that the bought company has a high-profile name out in the market, so the buyers want to capitalize on that. Now they own the rights to the name and will run with it as far as they can. Mergers can be done with both private and publicly held companies. With a private company, you simply make a deal with the owners. With a publicly traded corporation, you have to make deal with the shareholders, which essentially comes down to making a deal with the majority shareholder, either an individual or some other form of investment group. These types of deals could get complicated and take several years to resolve. All assets and liabilities transfer from the seller to the buyer when the merger agreement is filed with the state corporation offices. If the two companies reside in different jurisdictions, the deal gets more complicated in order to satisfy the rules in both jurisdictions. The merger deal is all about the buyer and seller coming to a valuation determination for each company, which is the basis of an agreement regarding the number of shares of the buying company that will be traded for each share of the purchased company. Before you merge, you hammer out a contract. There will first be preliminary talk to determine if you are both on the same page, if there is a preliminary meeting of the minds. Some paperwork regarding contract merger talks are non-disclosure agreement pledging complete confidentiality about the discussions. Each side provides their financial and non-financial statements to each other. Discussion of the direction and vision of the new business. The legalities, exactly what will each side contribute to the new business? What liabilities will they keep? What employees will they keep? Where will the new business be located? What will each side legally own? What will each partner do in the business? What will each partner be paid in the business? Who will the new business use as accountants, suppliers, etc.? What will the name of the business be? After you hash things out, draw up a formal agreement. In an IRS type a merger or reorganization, the target company is absorbed by the acquiring company, then does not exist anymore as a separate corporate entity. In an IRS type B merger, the sellers must exchange at least 80% of their existing stock for the stock of the acquiring company. They then operate as a subsidiary of the acquiring parent company. Another type of Type B reorganization is a reverse triangular merger, where the parent company establishes a brand new subsidiary, then they merge, and instead of trading as two separate stocks, they become one stock, the stock of the mother company. In a partial merger, the acquiring company buys only a part, not all of the equity interest in the target company. The ownership of the target company is shared between the two companies. They make decisions jointly. Think of it as a partial investment in another company. These are often used when the parties can't come to an agreement on a full merger. It's a way for one company to get its foot in the door of another company. From there, they might go on like this, merge fully or form another type of company like a joint venture, an entirely new corporation or a partnership. Acquisition Guide. Many companies who are doing well and have a bit of profit get bored being one-trick ponies, so they look around to find a company to buy in order to diversify and keep themselves inspired about their business. This is the aesthetic-inspired spiritual reason. They also do it for purely business, capitalist reasons, to either expand their current product line market share or to diversify. They call it generating net worth and building value. They say it's to increase personal compensation/wealth, but I think it goes beyond money. After $10 million, who really needs more? I think it's a mix of ego and the general restless spirit of man to always want to be doing more, not necessarily acquiring more but doing more. Because my work inspires me, I'm always doing it. This is what I thrive on. I could have gone to Jamaica to do cocaine and culture my own little harem of hookers, but this is not enough. You can only do this for a little while, then you want to use up some creative, inspired energy. This is why I think all these business people with more money than they'll ever need continue to develop their companies. It's part of the restless nature of the human spirit to constantly seek new stimulation that interests and inspires us. The game of capitalism is to grow, 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 grow. Keep investing your returns into something bigger and better. For what I don't know. Apple, Google, and Microsoft have enough business to keep them going, but they just keep growing. It seems to be the nature of the corporate beast. Most big corporations who buy smaller companies usually do so for honorable reasons, because they want to produce better widgets and expand, which is the game of capitalism: bigger, better, faster. Overall, the reasons most companies acquire others are: 1. For fun, interest, and inspiration. 2. Growth of the company. 3. Increase the value of the company. 4. Increase personal earnings. 5. A bigger, diversified company reduces market risk. 6. Acquisitions could lower overall costs, depending on the company, while producing the same output as for the two separate companies, therefore increasing profits. 7. A bigger, diversified company gives you more of a commanding presence in the marketplace. In a publicly traded company, shareholders in the absorbed company are compensated with shares of stock in the master buying company. The shareholders and employees of small companies generally like to get absorbed by bigger companies, since it usually gives them brighter future prospects than they previously had on their own, except in the relatively rare cases of corporate vulturism or corporate raidership, where some unscrupulous corporate CEOs or other investors gobble up little companies solely to get out some hype and raise the price of their stocks while trashing them, selling off their assets for what they can get. Firing the employees. Buying or acquiring a company is usually much more complex than buying a house, because you're not just buying a physical building. Sometimes you're not even buying a physical building. You're buying a few machines, a company name, and a developed customer base. In some cases, people acquire a company just for its long-standing name, then start producing widgets under that name. In general, acquiring a company involves a building or two, the machinery, the reputation of the company, the customer base, its employees, and its paperwork. You can either go in, get a global, intuitive feel for it, then make an offer based on their asking price, or, as is most often the case if the company is big, get your team to analyze every aspect of it, then negotiate with them for a while. There are risks in buying any new company, but the risks are minimized by a thorough investigation of it before you buy. There are basically two types of acquisitions. You simply buy companies in your field like your competitors until you're the top company controlling the industry. You diversify, get into other fields, buy a wide range of companies. The safest way is obviously the first option, but a lot of companies have made it as conglomerates. They get bored of their field, so they expand outside of it. Acquisitions are not just for big companies. Small companies do them too. They want to expand to get bigger, better, and more profitable, so they get in on the buying a company action too. At the very least, you need a corporate attorney with expertise in acquisitions and a corporate accountant with expertise in this area. Look for a corporate financial consultant too. Type these job titles into search engines to help you find these types of people. You might think that an acquisition is a simple transaction at an agreed upon price, but there are things you don't know about it, like the tax consequences of such a purchase, which is why you should hire a few professionals who know what's going on, even if you think it's a simple deal. The 3 golden rules of buying an acquisition are: can you really afford to spend the money? Can you afford to spend the time running it over and above your main company? Do you have the intelligence/expertise to run it? There are 2 ways to look for companies to buy. 1. See what's on the market for sale right now, or if you hear about a company for sale through the grapevine, check it out. 2. Do some research in the following places. Through the grapevine: business brokers, the yellow pages, trade association websites and magazines, trade shows, North American Industrial Code, corporate/industry websites. Use the corporate/industry websites listed elsewhere in this book. Make a list of companies you might be interested in buying. Send them all a letter or email telling them you're looking for companies to buy and they are on your list as a possible one if they're interested in talking about it. There is a great danger in acquiring a company. The term is commonly called biting off more than you can chew. Don't do it unless you think you can handle it without sacrificing attention to your main company, because there are many cases of successful companies expanding only to lose it all because they were too stupid to slow down. Do some research and exercise some caution. If you buy a company and find you can't handle it, either sell it or find a competent, honest team to manage it for you. It's not about the price. What it's really about is the future potential earnings of that company. If you're making a lot of money by running this new company, you can virtually pay for it out of its own profits in several years. There was the case of one company who did all their research on the dollar value of the company they wanted to acquire and squeezed the seller as far as they could, but they failed to do market research on the product line, only to discover it was a dying industry. So despite all their impeccable, miserly negotiations, they ultimately were the losers. Remember, the nuts and bolts of the company is not nearly as important as the market for the goods. If the market is good, you can always build a better factory and make your money back. If sales are poor, you're screwed before you even start. As I've already said, there are 2 major types of acquisitions. New product line. Same product, you're just buying up a company to widen your geographic market. Generally, the most successful acquisitions are in an industry where no one is a clear leader and one company buys up several others. You know the business already. You're just expanding the market share. I'm not going to get into a long harangue about what kind of research to do on the company you want to buy. There are checklists everywhere for this, at sba.gov, in books at number 658 at the library and on the web. Just do 3 things. 1. Do some nuts and bolts research on what the company hardware is worth, the building, the machines, etc., how much money they owe and their accounts receivable, how much money the company is owed. 2. Investigate true sales. Don't listen to what the owner says. You know he's gonna say sales are good. Sit outside the business and watch for a while. Talk to competitors about the nature of the business in general. Do some internet research on the industry itself. 3. Get an intuitive feel by walking around the place, inspect the vehicles, talk to employees, customers, etc. Look at the product itself. How great and unique is it? There's no automatic, foolproof way to calculate the purchase price. Start with the seller's price and work from there. There's an in-depth formula for buying a business at sba.gov, but it seems too complicated for me. If it's a big purchase, hire a corporate financial consultant to figure it out. Other than that, use your gut instincts. The money handed over at closing is one thing, but there are several other important considerations that figure into the final deal, like: what are the payment terms? How much money up front, then how much in monthly payments? How long will the former owner, management team, and employees stay on to help you learn the ropes? What will you pay them? How is that industry doing in general? How is the economy doing? The understanding is that as the buyer earns money through the business, he pays off the mortgage with it. If you know anything about real estate, you know there are many creative financing techniques such as balloon payments. This is an agreement whereby the buyer agrees to make minimum monthly payments with the understanding that at the end of the third year or the fifth year, he will make a large payment of 25% or finish paying it off in one lump sum, the presumption being that his finances will be better off by then due to his efforts in building the business up. Quite often, the seller himself offers the buyer what amounts to a personal mortgage. The buyer hands over about 20% or more as a down payment and agrees to make monthly payments directly to the seller. This is usually called a purchase money note. The seller may or may not charge interest on what is owed. Real estate books are at number 332.70 to number 333 at the library. The seller might also charge a consulting fee or a salary to stay on for X number of months to guide the new owner in how to run the business. Sometimes the seller even wants a clause stating that he wants a percentage of future profits for the next 5 years or so. The 3 most important documents in structuring a deal are: financial evaluation, the letter of intent, the transition plan. These are usually initially drafted up by the buyer's team of professionals with all the conditions the buyer demands in order for the deal to go through. Then they negotiate with the sellers to come to a final agreement. The sellers of a company are just like the sellers of a house. How motivated are they to sell? How emotionally are they attached to the business and think they have a gold mine there? You have to feel them out, then make an offer not just based on financial statements but also based on their psychological state of mind. As the buyer, investigate the tax consequences of buying a new business. When publicly traded companies are acquired, the ego factor makes the stock price artificially high for the buyer. He wants to show good intentions and get everybody on his side, so he almost has to make an offer 20% or so above the going stock price to keep everybody happy and make him come off like a good guy. This is generally the way it works. Publicly traded companies are expensive. Don't expect to buy a gold mine that will produce lots of profits immediately. Expect a slow, methodical business that makes money one customer at a time, the way most businesses operate. Don't be brainwashed by the seller's rose-colored projections. If the business is really great, why would he or she want to sell? Expect a regular, average business. In a straight cash deal, you're buying the company hardware, not its liabilities, as with the purchase of a publicly traded company. You buy the equipment, may operate under its name or yours, but as the new owner, you have no legal ties with the previous company. Quite often, the buyer wants a non-competition agreement from the seller whereby the seller agrees that he will not start a similar business in that geographic area for a set number of years. When you're making up the contract for the sale, the bigger the company, the more detailed it should be. Don't leave anything to chance or assumptions. Get it all in the contract. Everybody has good intentions. See the reality of the situation rather than the rosy picture the seller is painting. Buying companies is like buying real estate in the sense that there are times when it's a buyer's market when the economy is bad and times when it's a seller's market when the economy is good. Bide your time. Buy when the timing is right. Get good experts to help you through the deal, then get good managers to help you run the company. You're buying a business. The bottom line is money. Don't let your ego get attached to it or fall in love with it like some home buyers get attached to homes and end up paying double what it's worth. Be realistic. Don't go in with rose-colored glasses on. Most businesses come down to the same thing, an average, ordinary grind of routine work day after day. Expect some hidden surprises in how to run the business. So, to review, the steps to acquire a business are as follows. Decide on why you want to acquire a new business. Draft up your strategic business plan. Find some professional experts who can help you with an acquisition, a corporate financial consultant, a corporate attorney and a corporate accountant. Some other people you might use are a real estate appraiser, equipment capital appraiser, an insurance agent and good managers ready to take over the management of the business. Pick a geographic area. Find all the businesses in your particular field in this area. Do some research on them. Identify the ones most likely to sell. Contact them. Tell them your intention. Ask them if they want to talk about it. If they decide to talk, offer a confidentiality agreement stating that anything that either side says will be kept private. Send them a corporate profile, explaining exactly who you are and why you want to buy a new company. Send them a request for basic information you want about the company and specific questions you want answered. Meet face to face. If both sides think they can work out a deal, the buyer drafts up a proposal letter/letter of intent, which is the first form of the contract. They haggle and negotiate until they hammer out a deal which includes not just the selling terms but a transition agreement. After this contract is worked out, there is a time period where due diligence is conducted. What this means is that each side and their lawyers make their accounting books and facilities open to the other side so they can inspect them in order to see if the tenets of the contract are in order, to see if each side is being forthright and can back up what they claim to bring to the table in the contract. Even though due diligence is mostly for the buying side to inspect the financial records of the company they are buying, the selling company has the right to check the buying company's statements to see if they have the money and the means to actually do this deal, not do as some do, buy the company, trash it for whatever they can get then walk away. The experts say that no matter how much due diligence you do, there will always be some unpleasant surprise when you actually take over the company. The main elements of due diligence are as follows: financial statements, personnel records of employees, sales invoices, contracts, supplier invoices, the production facility, the patents or legal protection of the products. Process the paperwork. Tell the employees. Make the sales deal public. Start the transition. Have a few exit clauses that enable you to bail if certain conditions are not met. Don't expect a smooth purchase. There will be bumps in the road. Type C reorganization. With the IRS Type C reorganization transaction, the buying company offers X number of its own stock to the seller as the deal. By law, in order to be tax exempt from capital gains, they can't offer anything else. The target company is often liquidated and absorbed into the mother company, who take the physical assets over. In some cases, they take the liabilities and debts over, but the deal can be structured to avoid this. Refer to Section 368, A, 1, C, and Section 368, A, 2, C, of the IRS Code for more information about the Type C merger. Another rule of the Type C reorganization is that the acquiring company must take physical possession of all of the target company's assets. All titles must be formally transferred to the name of the buyer or the name of the subsidiary which is a puppet of the buyer. There is an exchange of stock. A Type C reorganization is non-taxable for both the seller and the buyer. There is no capital gains or income tax for either side. There are also limits on the liabilities assumed by the acquiring company. Chapter 3. Merger and Acquisition Websites. Merger websites / acquisitions websites. 1. WT. Grimm & Co., 33 West Monroe St. Chicago, Illinois 60603-5300312-368-1114, publish an annual report on mergers and acquisitions called MergerStat, as well as offering consulting services to buyers and sellers. Try mergeregist.com or wtgrimm.com. Try number 338.83, number 658.16 or HD 2746.5 at the library. Most of these websites are M&A consultants. IBBA.org, International Business Brokers Association. MErgerNetwork.com. MErgerAcquisition.net. NLJ.com, National Law Journal. ABA.com/industry /issues/issues_ma_menu.hdm. ACG.org, the Association for Corporate Growth. Acquisitions.aboutinvesting.org. ACQUISITIONS-MERGERS.com. ACQUISITIONS-MONTHLY.com. Allbusiness.com. Anania.biz, financial and advisory services to Maine and New Hampshire businesses. AOP.com, merger and acquisition services. MAAdvisor.com. MAAjournal.com. MAAWell.com, connects sellers with buyers. MAAReport.com, mergers and acquisitions report. MAASource.org, a division of the International Business Brokers Association. McDowellBB.com, Dallas. Mergers.com/index.htm. Mergersacquisitions.com. Mergernetwork.com. Mergerplace.com. Mergersbusiness.com. Mergers.com/about/about.htm. Mergers-acquisitions.com. Mergerwizard.com/corporate acquisitions. Mergidex.com, financing for corporate acquisitions. Moneysoft.com, successful acquisitions software. MoreRConsulting.com, brand valuation services. MWE.com/mergers. Merger and acquisition websites at FeedSpot. ClearyMaWatch.com. CooleyMaw.com. corpgov.law.edu/category/mergers-and-acquisitions. quorumgroup.com/insights. deallawwire.com. deallawyers.com/blog. dealroom.net/blog. mawcouncil.org/blog. mccarthy.ca/en/insights/blogs/Canadian-ma-perspectives. newyorktimes.com/topics/mergers-acquisitions-and-divestitures. pwc.blogs.com/deals. theguardian.com/business/mergers-and-acquisitions. tkomiller.com/blog. transactionaldelights.com. turkishmergersandacquisitions.wordpress.com. blog.feedspot.com/m_n_a_RSS_feeds